Hi everyone, it's great to be back at the SETTF Festival 2025. Great to see you all. I'm very happy to be here today on behalf of Tech for Net Zero, which is a network of more than 70 climate tech companies, startups, scale-ups, and venture capital investors in Germany, Switzerland, and Austria. We are honored and humbled to be a great partner of DENA, the German Energy Agency, and we're very happy to see many enthusiastic entrepreneurs, investors here today. And now we're really glad to have the opportunity to host this panel. And no worries, I won't be here alone. I'm very happy to announce 4 great panelists who will join me here in a few moments. And I will start with, and I'm very happy that she's here today, Irene Gálvez from the European Investment Bank. Great to have you with us. Next, I'm happy to introduce Anne Hinze from the DeepTech and Climate Fund. Welcome to Berlin. And next on, coming from the UK, we have Sweeney. Happy to have you here. Oliver's from Lightrock, and we're glad to hear about his experiences. And last but not least, Kaspar Schuchmann from Ineratech, CFO. Please take a seat, grab a handheld, and let us maybe start by kicking off with the topic of first-of-a-kind financing. So maybe you've heard the term FOAK. What the FOAK, first-of-a-kind financing. As I said, Tech for Net Zero is a network of climate tech companies. So we're actively debating public policy issues, financing issues. And what we found out in the past, let's say, 2 years, is that we have a very specific financing gap when we look at asset-heavy climate tech companies. And this is particularly relevant for those companies that face new projects, for example, companies in the field of green chemicals, e-fuels, that want to build new factories. And those companies with those new financing projects face specific challenges because their projects are innovative. They are very new. The classic financing experts are not that familiar with their financing challenges, with their technologies. And this is what we term the first-of-a-kind issue. So the question is now, how can we bridge this gap? And first of all, I'm very happy again to have you all here with me. And I think, Irene, we're going to start a little bit by talking about what is needed from the European perspective. You're here on behalf of the European Investment Bank. Maybe you can say a few words about yourself, what you're doing, and how you look at this situation.
Hello. Hi. So good morning, and thanks for having me here again this year. I'm thrilled to be here. So Irene Gálvez, I'm heading the Cleantech Growth Capital team at the European Investment Bank. And in the team, we're supporting European innovators scale up their clean technologies across the EU27, Norway, and Iceland through our product, which is growth capital quasi-equity venture debt. So essentially, we're helping companies as they're scaling up close that bridge to bankability and to first-of-a-kind. So we'll talk more about that later.
Thank you very much, and great to have you with us. I'll pass on the handheld to Kaspar Schuchmann from Ineratech. You are an entrepreneur, you are the CFO of an e-fuel company, very interesting one. And what specific difficulties do you see yourself as a CFO of a clean tech company, especially when we look at FOAK financing?
Okay, checking the mic first. Great, thanks for having me on the panel. Really nice to be here in Berlin at this festival. Really nice to see you. Quick introduction. So as you said, I'm the CFO of Ineratech. Ineratech is the global leader in e-fuels technology, modular e-fuel production. We use green hydrogen and CO2 to convert it into synthetic carbon-neutral fuels to decarbonize hard-to-abate sectors, such as aviation. So these sectors, they are difficult to electrify, and they rely on high energy density fuels to find their path to decarbonization. So we're offering this alternative to the market. Inerotech was founded in 2016, is based in Karlsruhe in southern Germany. I joined the company around 2.5 years ago, after the Series A financing round, when the company was actually looking also to finance this first of a kind project. At that time, we had realized several R&D projects, many R&D projects actually, partly funded by grants, with VC equity. We had already built pilot plans for customers, so financed mainly by customer money, which is also a great way to finance business, of course. And then we embarked on the journey to develop and finance and construct, and actually now at this very moment commission the first of a kind production plant for e-fuels, which is based in Frankfurt on an industrial site where the hydrogen and the CO2 is available at the right quantity, at the right price. And this is the place where we are now very close to operation of our first of a kind plant, which is super exciting and a milestone the company has really worked on for years. It really took a lot of years to get to this stage, and there's still a lot of work to be done, of course. So financing and constructing such first-of-kind projects is, I think the challenges are so manifold. It's actually quite difficult to summarize. So I would just focus on two aspects of it. The one is, for Inerotech, we are in our core, we are a technology provider, but with the first of a kind plant, we are also for the first time really integrating this tech on our own in the full supply chain, starting with the feedstock and ending with the end product. This is the first challenge really of a first of a kind, that you have to actually go way beyond your core technology. The core technology for us is our chemical reactors that are super efficient to synthesize these e-fuels, and also fully integrated, turnkey-ready, modular plant that is integrating these reactors. But that's our core tech. When we now look at our Frankfurt first-of-a-kind plant, we needed to find the right site to build the plant. We needed to negotiate and agree on commercial contracts for the feedstock for the site. We needed to get the permits in place. We then needed to construct a whole lot of other things that actually were not our core tech, like starting with the foundation of the place, all the piping that goes in the balance of plant, a building that is housing compressors and the electricity trafos. And so there's a lot of, let's say, conventional tech and conventional construction that needs to be done, that, let's say, you don't need a startup for. But when a startup has the task to integrate that core tech into such a place and to manage this whole site and construction, that's a huge challenge, because the organization was not built in the first place to do that. But that's where the organization has to evolve and develop and improve. And typically, maybe those kind of works would be done by an EPC company, but the EPC, they are not familiar with your process, and they also don't want to take the risk, the capex risk of your project, because it's done for the first time. So all of these things are challenging for an organization from an operational standpoint, but also from a financing standpoint. And that's maybe the second main point I want to highlight, is the sequence of financing these projects. You would typically start with VC equity and hopefully a grant to minimize dilution, but that might actually not be enough to get this project financed, because you need 30, 40, 50 million euros, and the VC might not be willing or even able to put all that money into this one project, because you at the same time have to develop your tech further, grow the organization. So there's lots of financing needs in the company. So then you look at debt financing. Debt financing is typically what you want to include in such a project, but banks are super risk averse. They want to see how reliable your technology is, how much risk remains in construction, how firm and reliable are the offtake contracts. So there's a whole lot of challenges in the commercial structure of these projects that makes banks scare away maybe a little bit from such projects. So there's a lot of opportunities to help banks also engage in these projects. Public guarantees are one thing, and then other products like venture debt are other solutions. But the actual point I'm trying to make is when you raise an equity round, you maybe have 1 or 2 years of runtime. In that time, you need to agree on the debt or the venture debt financing. At that time, when you get to that agreement, maybe your equity is already run out, and you need to raise equity again to satisfy the bank's requirements. And to get that sequence actually right, that might take 3 or 4 or 5 years until you actually are really done with it. And we're happy that we, for now, reached that stage, and but it's hard.
Yeah, I can imagine. Thank you, Kasper, for also elaborating on the financing sequence. And you have 3 amazing financing experts sitting next to you, between us. And you also mentioned the venture debt program, for example. I think Irene can elaborate a little bit on that later. But let's start with Oliver. Oliver Sweeney from Lightrock. You are active in the field of growth financing. What's your stance on this financing issue? How do you look at the FOAC situation?
Thanks, Julian, and a pleasure to be here. Thank you for having me. Just quickly on Lightrock. So Lightrock is a global investing platform building a sustainable future. So we operate across both the public and the private markets. We advise funds over 5.5 billion euros, and we do that mainly at the growth stage. We have around 130 professionals investing out of funds that invest in North America, Europe, Latin America, Asia, and also in Africa as well. We operate one of the largest climate strategies here in Europe as well, investing out of an 860 million euro fund, 10 to 50 million equity checks, but we can also scale beyond that as well. And we're really looking for proven, scalable technologies that can deliver net zero by 2050. So that's a little bit about Lightrock. And then if I pick up on some of what you were saying, actually, I think it goes without saying, but everyone in this room will probably understand it, but hardware in energy and climate is difficult. It has to work. It's not like a software product where you can build part of the product and then you can ship it, then you can iterate and find product market fit, and then you scale it, and all for relatively little capital. Some of these technologies are going into mission critical operations within industry, so they can't only partially work. They have to work at scale with on-spec product at the end, and they have to be commercially viable as well with the right techno-economics. So if I look at some of the problem that exists in this space, and I think it's probably exaggerated over the last 2 years, whereby, and we invest at the growth stage, but I think that growth capital has actually become more conservative, actually. So we're looking for more de-risking, we're looking for more proof points. And so whereas previously we might have been okay to invest at the first of a kind stage, we're now actually looking for some of the proof points that come with first of a kind. And what that leads to is inherently you have more of the burden and more of the work needing to be done by venture or earlier stage capital. And that capital can only go so far. These journeys are prolonged, they take more money, and that's essentially where some companies can end up choking out and not able to raise that capital. So then we're into the conversation around solutions and what we can do, which we might come to a little bit later on today. But I think we need to be more innovative around some of that capital coming earlier, find debt products with a lower cost of capital, but are better at underwriting some of these risks at an earlier stage, TRL 7 or 8 coming alongside this equity to support it so that you can spread the equity much more widely. And maybe just to highlight one of our portfolio companies, Sunfire, has been a huge beneficiary of some of the capital stack within Germany, but also in Europe. It has raised a working capital facility that's backstopped by the German government and is underwritten by 3 German banks. It's also raised capital from the EIB as well, so very fortunate to be supported there, and also R&D and grants. But that's all on top of over 200 million worth of equity. So Sunfire had to get through all of the things that Casper was mentioning over a number of years and raise over 200 million of equity before it could then unlock some of this other capital. And any point along that journey, Sunfire could have also stumbled and actually reached that choke point as well.
Thank you very much. So personally, this helps me a lot to better understand and to hear your perspectives about the first-of-a-kind financing issues. But of course, we would like to have this a very interactive panel. And also, the technical team has prepared a QR code, which you can use in a few moments. You can also enter your ideas. And the question that we have for you is, what are the biggest barriers to first-of-a-kind financing? We're very interested in your perspectives. We'll pick up the answers later. But before we talk about what you see as the most pressing challenges, of course, we have some solutions ready for you. And I'm very happy to now pass on to Anne from the DeepTech and Climate Fund. I think personally, someone who's very interested in politics, I think it's a fascinating concept. But maybe since we have some international guests, not everybody's familiar with the DeepTech and Climate Fund, maybe you can explain a little bit what your business model is, how you work, and how you look at this specific financing situation.
Thanks a lot. Thanks a lot for having me. Happy to introduce the DeepTech Climate Fund also to our international guests. So the DeepTech Climate Fund is a public VC fund that is really addressing part of this gap that we are mentioning. So we really try to enlarge in European equity growth rounds. It's a 1 billion fund backed by the German government, so really public money that goes into early stage growth capital. And we do invest in, as you can tell from the name, deep tech and climate tech companies, so really also capex heavy folk financing, so really addressing these companies that typically struggle to address equity or to really get equity, and there's still a bit technical risky around stages. We do invest typically at Series A, B, so really the growth stage. So this is like the gap that we've seen in the market. When it comes to pre-seed seed funding, there are already a lot of VCs that do finance these startups, but when it comes to really double-digit, almost three-digit equity rounds, then it becomes rare in Europe to get really this equity financing. And what we do is we invest pari passu with private investors, so we need to unlock more private capital in these markets. So we need a private investor to co-invest with us and add 30% of the round, and then we can invest up to 70%, so really 70 of that round with public capital. And this is really the aim then to unlock this, leverage this private capital to make it more feasible for these companies to make it in Europe and not have to go to out of Europe to the US or wherever. So this is really the idea of us, of the DeepTech and Climate Fund. We started, I think, investing almost 2 years now. We are about to announce our 14th investment. So really a broad range also in deep tech and climate tech. And yeah, we also have really climate tech and really capex heavy startups like Sile. Maybe a few of you know them. It's a battery recycle company from Germany. Or Proxima Fusion, so fusion energy, so really capex heavy. We're not reluctant to do that. So really that is the idea. Of course it's equity, so it's dilutive, but nevertheless it can at least partly address this gap by unlocking more private capital.
Thank you very much. Personally, I'm a big fan of the concept, and I think it's a great way also the DTCF has been developing. So thank you very much for joining us today. Now we switch from the national perspective to European level. Irene, looking at the European Investment Bank, you have a very, I think, interesting profile, also on track record in terms of investments in Cleantech. You are the Cleantech expert here sitting on behalf of the European Investment Bank. So I'm very curious about your perspective. What could the EIB offer to some maybe Cleantech entrepreneurs sitting here in the room? What are your programs that you are proposing?
So thanks. It was really interesting to hear from Tech. We're supporting and also the colleagues on the challenges. The European Investment Bank is the bank of the EU. So we actively target these market gaps that are perceived. We have, in cooperation with the European Commission, trying to help address crowding additional equity investment and private capital into hardware clean tech companies. So what we do is we provide venture debt to innovators that are developing technologies as of TRL 6 and above. So we come in quite early to actually bridge that sort of growth or that bridge to more proven technologies. And we provide less dilutive capital or non-dilutive capital in the form of venture debt, helping, we had the challenges that people have been voting, helping some of these challenges, meaning there is at that point of investment a more high capital barrier, so people need to raise much more money than software sectors. Risk perception at a time where the technology is actually still very risky. Wouldn't say binary, but it's still very, very risky, far from being proven. It needs that first of a kind to reach that stage. We deploy indirect investment, so this is not through funds. We invest directly in companies between 400 and 500 million a year. We also support the Sunfire, and what we see indeed, and I can corroborate, is that everything needs to happen at the same time. I think that when people speak about the climate stack, it's really a reality. Either it happens and we all come together at the same time, or companies run out of cash, get choked before you actually reach that next round. So success stories like Ineratech, like Sunfire, are those companies that managed in a short period of time to put all of these resources together. So we do direct investment, going back to your questions, in the form of venture debt. We do advisory services. We can provide financial and technical bespoke advisory services to companies, getting them ready for funding and for financing. And we do blended finance as well. So we are piloting in Europe with partnership with Breakthrough Energy Catalyst, a blend of resources, public and private sector, for 4 critical technologies, climate technologies: decarbonization of industry, long duration energy storage, SAF, DAC, and did I say long duration energy? Yes, and hydrogen and clean hydrogen. In Europe, together with them, we put together grant funding with venture debt, quasi-equity for the benefit of this project. So we are trying to help put together all of this capital that is needed to grab this technology. So direct investments, advisory, and blended finance.
Thank you very much, Irene. And you also mentioned the investment case of Ineratech. Now we have the CFO of Ineratech sitting here on the panel with us. Kaspar, how do you look at these programs, and what was your personal experience also with the specific partnership with the European Investment Bank?
It was a great experience, and
yeah, be careful what you say now.
You have to say that.
No, I think the EU Catalyst program is really a promising solution for this FORC financing gap and challenge. We actually started talking with the EIB and Breakthrough Energy after our Series B equity round.
We met here last year,
we actually for the first time.
And I have a colleague, and we have a full agenda of bilateral meetings, because we're actually here to try to help, right? And so
yeah, that's
sure
actually
that we connect.
quite a big plus for this conference. I met you here for the first time, and I also met Mario Fernandez from Breakthrough Energy Catalyst for the first time here. So yeah, this was really the kickstart of our discussions that then turned quite dynamic. So what is really attractive about the EIB venture debt is that it's expanding the capital stack. So it's basically a quasi-equity instrument. So it comes with less dilution than equity, and it is a loan, but you don't have to pay cash interest. So it's deferred interest. So those elements make it really great addition to an equity financing. And what's even better, that Breakthrough Energy comes in with a grant as well, so that makes it more attractive even. And we really started these discussions in a partnership manner, I believe. So all parties came together to see what is really the need of Ineratech and what can be done. And what came out is that basically we're not only constructing and building our first-of-a-kind plant in Frankfurt, where we originally only went so far as to produce synthetic crude oil, but we are now also building in Frankfurt a dedicated upgrading facility to refine the crude oil to actually go to the final sustainable aviation fuel product that the market requires. So that's one of these outcomes which is really great. And on the other hand, Breakthrough Energy really comes in with I would say an outstanding and incredible experience in exactly that topic. So first of a kind fork financing, they are probably the experts in this field that have seen a lot of these projects and come with a network and an expertise and a really demanding technical due diligence process that where it's tough, but it's similar, let's say, to a sports coach that is really pushing the team to become better. So it's a steep learning curve for any organization to work with these partners. Same holds for the EIB that come with very complex financing contracts. So that's also a learning curve that you have to do. But it's all for the good of the company and the technology and the development. And I think that's why we're super grateful to have these partners on board to realize this amazing project in Frankfurt.
Thanks, Kasper. I now would like to come back to you, the audience, and I'm really curious what you stated as your most pressing issues, most pressing barriers when it comes to first-of-a-kind clean tech financing. I guess we'll see the answers in a few moments. And okay, so
all of it together.
Yeah.
I mean, most.
So maybe a good thing that we see there's the lack of public-private cooperation is not too strongly pointed, which I think also highlights what has been going on so far, looking at the projects that you just explained a moment ago, Irene. So risk perception, the high capital intensity, limited proven track record, and absence of returns in early stage. I mean, by the end of the day, it's always a risk-return profile, of course, but I think that what we can really agree about is, of course, the availability of capital and of the access to capital, looking especially at that capital. And maybe this helps us a little bit if we go into the next questions that I prepared for you. I think the question is specifically how we can mobilize and unlock more private capital. I think that's the crucial question right now in Europe. We have a public consolidation taking place across most European countries, except for Germany right now. I'm not sure who of you is following German politics, but as we're speaking here on this panel, the German Bundestag, the federal parliament, is debating a 500 billion infrastructure package. The good news, out of those 500 billion, there will be 100 billion euros for green projects, which I think is a very good thing. But let's see whether this money also goes into clean tech companies. It's quite open for interpretation what a green project could look like. But of course, we'll do our very best as Tech for Net Zero also to make sure that this money goes into climate tech companies, into really important projects to modernize and defossilize our German industry. But now let's go on, Oliver. From the UK, looking at Germany, what do you see as hurdles for companies, for startups in Germany to grow, to access capital that they need? What's your perspective?
Look, I think it's always easy to start with hurdles, but maybe I'll start on a positive note, which is I think that Germany has a great clean tech and industrial ecosystem. So if you look at the technical talent that comes out of universities, if you look at industry that exists here, and some of those industries, whether it's energy, automotive, or other, can actually foster that innovation. They can be the first customers for startups, they can be the scaling partners, and they can be the funding partners. So we spend a lot of time in Germany, not only with our portfolio companies, because actually it's got a very strong domestic market which can support some of these innovative companies from the get-go. Whereas other countries in Europe, those founding teams from day one need to think cross-border because they don't have that industrial domestic ecosystem to support them. So from day one, they're a little bit behind the curve and they have complexity that they need to deal with. And then one point, I think, on the policy side of things. I think what I always find with policy is the uncertainty of policy causes more delays than actually the policy being implemented itself. And what I mean by that is it's almost better to have a slightly suboptimal policy, but everyone knows exactly what it is, what it means, and that provides a framework for these companies within which to operate, to design their organizations, to build their strategies, and simply execute upon that. So the first point is policy and policy certainty. The second piece would be around policy longevity as well. It's not good enough to think that a policy will be in place only for 1 or for 2 years. It needs to be 5 plus 10 years because that's how long it takes for companies such as Sunfire and Aerotech to actually become established and to commercialize. And then final point, I think it's also a little bit more of the same. So we've talked about 2 success stories where there's collaboration, even just around this panel here today, but there's a multitude of others where that capital does exist. We just have to get together and talk about it, understand each other's risk tolerances, articulate those risks, understand each other's returns thresholds, and put together a funding mix that can make sense for these companies. Because I think it's a huge imperative, not only for net zero, but for industrial strategy, actually. Otherwise, we'll end up losing complete value chains to other parts of the world where we really don't need to.
I totally agree to that. Before we come to the other panelists and debate about other solutions, also we will try to have this again, very interactive. You can pose your questions by scanning the QR code. Also, if you have some questions that you would like to ask personally, please raise your hand in a few moments when we come to the Q&A part. Just think about it. When we have some ideas, some questions that you would like to ask to one of our great panelists, please feel free to do so. Caspar, when we look at the market, is there anything you miss in Germany that would help you to meet the capital requirements? Anything that you maybe would ask the new government to introduce? Anything that would help asset-heavy climate tech companies such as Ineratech?
There's a lot of instruments out there, and I think also a lot of instruments in discussions. So I think what is a really valuable and effective instrument is public guarantees. So, for example, we have a commercial debt financing, which wouldn't exist without having a state-owned bank, actually 80% guaranteeing the risk of this commercial bank financing, and that's really a great solution right there, because it also enables startups to engage with private players, be it private banks or other private players, but to start this engagement, although maybe the counterpart wouldn't be able to take the full risk on their own. But with the public guarantees, they're distributing this risk. You get into the conversation, and you get access to the capital, which of course is great, but you're also going through this learning curve of what such an institution requires. So that's maybe one point that I just think is very effective. And the other part is that whenever additional capital is provided, I think the key factor, the key decisive factor should still be private player scrutiny. So in terms of, it could be really a technological expertise that some players or teams have. They can really differentiate what solutions are have great potential and really have an impact in the long run, or they are really market driven and can differentiate on that side. Ideally, these two really meet together. But when let's say the private sector scrutiny is combined with catalyzing capital from the public, I think that's effective.
Makes sense, yeah. And talking about wishes to the new government, just remember a couple of weeks ago we had the opportunity to meet German Minister of Finance Jörg Kukies in the Ministry of Finance together with some other entrepreneurs from our Tech for Net Zero network, and we were talking about exactly these issues. And also I think we have some great examples already in place. Talking about the public guarantees that you mentioned, also the European Investment Bank has been a very, very great partner for us as Tech for Net Zero to debate such potential solutions. I think what the EIB has introduced with special regards to the wind industry, for example, in Europe is outstanding. And Irene, is that maybe something that would make sense to extend, or is that something that you're working on right now to make it easier for clean tech companies to access capital?
So yes, but before I say that, I think just to add, because we have many things going for us in Europe for the clean tech ecosystem, also and in particular in Germany, we have lots of strengths. But also in Europe, what we see is a really low participation of the private credit market into the sector. That is what it is, right? And that is for regulatory reasons. That is for lack of a capital market union properly, developed in the continent, and that has to improve and that has to change, right? For everything else to catalyze, we want these companies not only to grow in Europe, but to stay in Europe, to IPO in Europe, right? So we're missing that, and that is what it is. However, I think that none of us around this table had the key to unlock that, but that has to be said. Now, this means that we have a growing investment gap in the sector. And I think that Draghi, I think the total identified gap was 800 billion. The one for energy, including clean tech, is 300 billion. It is impossible that the public sector can cover that, right? So we're going to have to be looking at elements to crowding and de-risk for the private sector to be able to take more of their share that they're having. Okay, let's just be honest. The public sector cannot fill this in. So I just wanted to mention, because it is impossible, right? Like, that the public sector will come into the rescue. Everybody has to play its role, and they have to come in more into the space. Counter guarantees, yes, they are an effective way to get banks to begin getting more comfortable with the asset class and due diligence on these sort of emerging technologies. We are working at the European Investment Bank on 2 additional tools for our toolbox. One is in extending this wind sector package counter guarantees to emerging clean technologies, so unproven, so essentially clients that would be a venture debt risk category, so not investment grade like the wind sector package, but really innovators that don't have access to commercial senior lending yet. So we're working on that, and we will be working with banks to get them into that pari passu resharing into the asset class, right? So that they begin that relationship with banks earlier to unlock working capital facilities for these working capital intensive companies that need these lines to be able to grow their order books and to scale up. So this is critical. This is a file that we're heavily working on at the moment, developing the product, and we hope to have it up and running this year. So, and then we also see a gap in this scale-up segment. What we call scale-up is really companies that has proven technology, but they're not profitable yet. They have a strong growth revenue. Maybe they can be profitable in the core market, but not internationally, or expanding to new markets, bigger tickets from 50 to 150 million. Those type of companies, we see as well that they struggle. They are not quite ready for bank financing. They're very price sensitive, so they're not going to go for the usual, venture debt lending, but more like towards the debt. So there we're also developing a facility for scale-up companies in Europe to help them stay, essentially, and not actually get the successful ones to leave the continent. So those are the two new files, I would say, for this year.
Sounds very good. Anna, would you
May
like
I add directly?
Yeah,
Yeah,
please,
right. As you were mentioning that everybody has come into play, like I think we are all aware of that, but no one really explicitly mentioned it. Like off-take agreements are so important here, and that's also part of the results of we've seen, right? There's a lack of proven track record, there are no returns yet, but off-take agreements can really help to get, also for banks then, the reliability that the product, the revenues are secured and that there will be like customers for the product. So that's definitely something where also, again, the state could come in as first customer. Obviously, that's not applicable for all products, but at least for part of the products. And also what I like for the Sunfire consortium, like I think the construct was that there are banks guaranteeing for customer advance payments, right? So I really like that there are customers actually like financing with advance payments the facilities, and then banks guaranteeing for that, and then the state came in and guaranteed for that bank loan. So that's really, everybody has come to get together, like the public, the state guarantees, customers that have to dare, that have to like give it a shot with startups and bring it together. And also maybe one last, because we are like focusing on like solutions here. Yeah. What is also hindering VCs to really get into this forward financing thing is the investment horizon. Typically, the funds have a term of 8 to 10, max 12 years, and that's partly not long enough for this forward fund. When it really comes to get like positive returns, reach break even, that's still a long way to go then. And therefore, like a secondary market could also help, like for VCs, so that like VCs can step in, but know like as soon as their fund term is over, they can then hand it over to maybe funds that are not that risk averse, and infrastructure funds can come into play. So this could also be a helpful instrument.
Thank you very much. I'm afraid time is up almost, but we got two questions, I think, here, which you can see on the screen. Maybe to all of you, maybe who would like to answer venture versus bank debts, which is better for fork financing? Irene,
can I take this
please.
one, please? I mean, we can complement each other, but I want to say, guys, the point about getting this folk finance is to do it quickly and get it done. So you don't know how many clients come to us and they want to get project finance from the outset, and the risks are just too high. And they take a couple of years to actually come back and say, maybe we want venture debt to make sure that we at least get the project built and commissioned. The problem, so the objective of these financings are to get them done, because what you want is to have access to the pools of capital that have the lowest capital requirements. So the infra funds, the PF lenders, those are the ones that are going to be matching the returns of your assets. And those are the ones that you want to get access to as quickly as possible. So if you're doing a folk financing with significant technology risk, the likelihood that you're going to go more for venture debt than bank financing, or hybrid, let's say quasi-equity, is higher. But that will get your technology proven, that will get the demand consolidated, and that will unlock access to the longer off-takers and everything else. Voila, that's what I wanted to say.
Thank you very much. Before I now come to the closing of the panel, I would like to say a few personal words. First of all, I would like to extend my best wishes from Tobias Lechtenfeld, who's the executive director of Tech for Net Zero, who's now on parental leave and sends his best wishes. And also I would like to say thank you to the amazing Tech for Net Zero team sitting here in the front. Angelina, Lea, and Leander, thank you very much also for doing all the preparation in the past few weeks. I've been busy with some other work, maybe also on a personal note at the very end. This is my last day at Tech for Net Zero because I got elected into the new German Bundestag. And so right now the old parliament is debating about this 500 billion infrastructure package, and next week Tuesday will be my first day, and we have to deal with how to actually allocate this money and also how to refinance it. Will be a big challenge, I guess. But I would like to say thank you for all the great work, also the team did, but also the great personal relationships I could build in the past few years in the climate tech sphere, and I'm looking forward to continue working with you now from the political side of the aisle. And having said that, I would like to extend my thanks to this amazing panel. thanks to all the 4 of you for joining us here today, for your great ideas, for all the amazing work you do. And it was a pleasure talking to you. Thank you.
Thank you.
Thank you so much, Julian, for the wonderful hosting, and all the best for your new position.